Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, President Trump taking the market on a roller coaster ride as he softens his tone on China. Trump posting over the weekend that all will be fine when it comes to trade relations with China. And this comes after Trump threatened an additional 100% tariff late Friday. Some of the winners so far in the early action, chip stocks and shares of rare earth mineral companies. We're also seeing a rally in the broader market as investors come in and buy the dip. Futures rebounding from Friday's sell-off with more than $2 trillion was wiped from the market on Friday. The Nasdaq and S&P 500 are the top performers ahead of the open. But Morgan Stanley is warning of a sharp decline if trade tensions rise. The firm says we could see an 11% drop if there's no de-escalation in the coming weeks. While the stock market is open today, the bond market is closed. And the next test for markets, earnings. Big banks will kick things off this week. 4 of the country's largest banks report on Tuesday, and the expectations are for a strong quarter thanks to a surge in deal-making and trading. Let's get a check in on stock futures here. We do see indications for a pretty strongly higher open, a big rebound from what we saw on Friday when President Trump did seem to ratchet up the tensions with China and then over the weekend trying to sort of bring them down again. So let's dig into our top stories of the day here. Trade tensions between the U.S. and China. As President Trump writes on social media, don't worry about China. It'll all be fine. Futures bouncing back after markets shed $2 trillion on Friday, and JPMorgan announcing a $10 billion initiative as bank earnings kick off. Joining me now, Yahoo Finance senior reporter Brooke DePalma at the Nasdaq, Yahoo Finance banking reporter David Hollerith, and Morning Brief's Market Sunrise host Ramzan Karmali. Ramzan, I'm going to start with you. Obviously we have seen this sort of back and forth resurgence with China here, but it looks like the markets are reassured this morning.
I love the way you put it, Julie. Donald Trump telling everyone, don't worry, it's all going to be fine. And that's actually sent, as you said, US futures higher today. But European stocks as well in the main, they were on the rise too. The president seems to have taken a more conciliatory tone. Just look at what he wrote on Truth Media. He wrote that highly respected President Xi just had a bad moment. He doesn't want depression for his country, and neither do I. The USA wants to help China, not hurt it. Now, remember, on Friday, Trump had threatened to impose additional 100% tariffs on China. And he even suggested that he could cancel that planned summit with President Xi Jinping, which was meant to be taking place later this month in South Korea. So what's caused Trump to make these threats in the first place? Well, Beijing unveiled a package of export controls on rare earths. China's also slapped new port fees on US ships and launched an antitrust investigation into Qualcomm. And Beijing has also halted purchases of US soybeans, which has really had a massive impact, as we've been reporting on Yahoo Finance, on US farmers. Now, interestingly, Asian markets, they were down quite sharply actually, and they were bucking the trend. And basically the reason behind that is they're more exposed to the Chinese economy, and trade tensions clearly had investors in the region pretty worried. Now, US tariffs on China of nearly 145% in some cases are on hold until November the 10th, while the two countries try to make progress on a larger trade deal. Now, Chinese tariffs on US goods ballooned, if you remember, to 125% before the pause as well. Now, for its part, China has warned the US to back off with tariff threats and said it will retaliate with higher tariffs. Now, Beijing has already started to fight back with restrictions, as I said, on rare earths and also on the export of batteries. China has also urged for negotiations between Washington and the US to continue. So basically the question we all have to ask ourselves is, what have we learned in this last sort of 72 to 96 hours? What does all this tell us? Well, it tells us that these two big world economies, does it tell us whether these two big world economies are ready for a trade deal, or can the current agreement that we've got carry on to be rolled on, or are we heading for no deal at all? And those are basically the key things I think that are on the top of investors' minds. Obviously, the first two are a lot more palatable than the last one. And on top of all of this, early next month, the US Supreme Court is set to hear a challenge to challenge Trump's most sweeping tariffs. the reciprocal country-by-country duties. For example, there was a 46% tariff on Vietnamese goods, 25% on South Korean, and 24% on Japanese goods. And a ruling against the tariffs, which would be in line with the lower court decisions, could have serious ramifications and serious consequences for Trump's tariff strategy and the revenue the US has collected so far from those duties. And there's also some interesting analysis as well from Goldman Sachs as well this morning. They reckon that American consumers, they're going to pay off more than half of President Trump's tariffs compared to what companies will pay. They think companies will be hit with something like a 22% hit, whereas consumers will bear the brunt of tariffs. We're paying 55% of the increase in costs.
Ramzan, so all of that is what investors are weighing right now. And Brooke, we're seeing a pretty sizable bounce back today.
Julie, that's right. All three major indices expected to open in the green this morning, with the NASDAQ really leading the momentum. Keep in mind, on Friday, the NASDAQ led by Amazon, NVIDIA, Apple were all companies that really led the decline that we saw. Keep in mind, on Friday, we saw $2 trillion in market value get wiped out from the stock market once President Trump announced that there was intention to implement that 100% tariff on Chinese goods. In addition to that, we did see the biggest drop that we saw in the matter of months as investors really weighed that tariff fear once again. And more than 420 members of the S&P 500 ended up in the red on Friday. And now in this early innings of this new trading session this morning, we are seeing some momentum back up once again. The NASDAQ leading the charge. But at the same exact time, we're hearing from rhetoric on the street that this momentum might not continue if there is not de-escalation here. That includes Morgan Stanley's Mike Wilson. They went on to say that if associated trade uncertainty and volatility continue into early November, they could see a larger correction between, as you see on your screen, an 8 to 11% decline from Friday's close. That would bring the S&P 500 down to 6,027 to between 5,800 points in a bear case scenario here. But on the flip side, we're also hearing from Citi's Stuart Kaiser that we could see some buy the dip sentiment return to this market here. And this will be the true test right now for investors on whether or not they're ready to rejoin this market and get in on what could, as many investors have been saying, larger S&P year-end targets. Also, Julie, throughout today's trading session, we'll definitely be keeping a close eye on gold and Bitcoin as we see both of those rally just a bit this morning, up a few percentage points as investors seek out safe havens in this market.
And David, of course, we're getting ready for bank earnings this week. But ahead of that, JPMorgan out with an interesting announcement that kind of sounds like what the government is doing in a way. It's going to be investing in sort of mission critical companies in the U.S., if you will. Can you explain to us what's going on there?
Yeah, Julie, as far as we can tell, it's connected, but a separate initiative. The bank today said that it would invest over 10 years as much as $10 billion into critical industries. These are areas like energy, emerging technology, aerospace, defense, and supply chain manufacturing infrastructure. Now, the bank obviously would have already invested a certain amount of money into these key industries, but it has this larger initiative to where it's sort of taking what it said as the baseline for what it would invest in these areas over 10 years, which is $1 trillion. And they're saying they would increase that to $1.5 trillion. And again, I've said invest is a sort of a broad term, but it means facilitate, finance, and invest. The actual equity investments we're seeing here are about $10 billion into these companies. So it's largely seen as, a key way for JPMorgan to underline its priorities in these areas. It's also sort of a way to organize its efforts in kind of targeting these areas and making it a part of a sort of a public accountability thing here. The bank is going to have an external advisory council that's going to include private and public sector leaders, and they're going to sort of guide the strategy there.
Okay, so that's what's going on with this announcement. And talk to us now about earnings, sort of big picture. What are some of the themes we should be looking for?
Sure, yeah. So on Tuesday, we have Citigroup, JPMorgan Chase, Wells Fargo and Goldman Sachs all reporting. Morgan Stanley and Bank of America will go on Wednesday. And really what we're expecting to see, we've already seen some deal-making data over the summer that should indicate it should be a good quarter for these banks in their Wall Street operations. Trading also is expected to do well from what we've heard from senior executives. But there's going to be some increased scrutiny into consumer and commercial credit this quarter. And that has a lot to do with, a few things. One, just given the government shutdown, investors will want to know how that could affect everything from student loans to IPO approvals. They'll also be kind of paying attention to what has happened in the kind of the middle market segment or traditional lending side of the banks. And that has a lot to do with these two automotive bankruptcies that are separate and maybe idiosyncratic, but nonetheless do kind of raise some attention to people who are not normally paying attention to this. The credit environment generally for the big banks over the past couple of years has been fairly good, and everyone I speak to have used terms like pristine and benign. And I think really we kind of learned through these two bankruptcies that generally corporate debt in America is kind of like that until it suddenly isn't. And although these are idiosyncratic scenarios, we're going to want to understand how the banks are thinking about this now. Bankers kind of have this talk that they bring up often, which is sort of that during the best of times, sometimes the worst loans are going to be made. So they're incredibly vigilant right now about that, given everything that's going on.
Brooke, David, Ramzan, thank you so much. Appreciate it. Some breaking news crossing the wire. Broadcom shares are surging. That's after the company announced a multi-year agreement with OpenAI. The two companies will collaborate on custom chips and networking equipment. As part of the pact, OpenAI will design the hardware and work with Broadcom to develop it. The plan is to add 10 gigawatts worth of AI data center capacity, with the companies beginning to deploy racks of servers containing the gear in the second half of 2026. By customizing the processors, OpenAI said it will be able to embed what it has learned from developing AI models and services directly into the hardware. This marks the latest step in the AI startup's ambitious plan to add computing infrastructure. OpenAI, of course, has signed a number of blockbuster deals this year, aiming to ease constraints on computing power. Those shares right now up 11%. Remember, of course, OpenAI has partnerships with NVIDIA, with AMD, so perhaps inevitable that in its quest to increase its capacity that it would sign one with Broadcom as well. We should note that there are no financial terms being disclosed as part of this. And also, OpenAI had already been working with Broadcom. This seems to be an expansion of that partnership. So we'll see if any more details come out on the monetary side, if we find out how much Broadcom might be getting as part of this deal. We'll have more Morning Brief coming up right after the break. Now time for some of today's trending tickers. We are watching MP Materials, Bloom Energy, and Fastenal. First up, MP Materials. The stock, along with other rare earth miners, extending last week's gains after China tightened export controls on the minerals. Recent trade tensions between the U.S. and China helping fuel the stocks after President Trump threatened China with retaliation. MP is the largest rare earth producer in the Western Hemisphere. The company makes key components of magnets that end up in high-tech products. The shares closed at a record high on Friday. They're up more than 400% this year. Next up, Bloom Energy. Those shares are surging after it struck a deal with investment firm Brookfield. The $5 billion deal will deploy Bloom Energy's fuel cell technology for artificial intelligence data centers. Brookfield and Bloom are collaborating to design and build what they're calling AI factories around the world. That will include a site in Europe that will be unveiled before the end of the year. And finally, Fastenal, sliding after reporting third quarter earnings. The company's earnings per share coming in slightly below expectations. Fastenal's operating income also came in below estimates. However, the company's sales did come in line with estimates at $2.1 billion for the quarter. The fastener and tool distributors grappling with a difficult industry backdrop driven by reduced construction activity. As always, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, stocks are bouncing back after wiping out $2 trillion in Friday's trading session as trade risks reemerge on Wall Street. Joining us now, Troy Gajewski, Future Standard Chief Market Strategist. Troy, it's great to see you. Just when we think we can kind of relax on the tariff front, some of these headlines come up again. Although President Trump effectively said relax over the weekend, right? Everything's going to be fine. So how are you trying to, sort of incorporate these headlines, or do you sort of put them in the background?
Yeah, I think in general, whenever you're embracing asset allocation, right, you have to put some of these noise headlines in the background. That being said, though, again, when you get to extended valuations like we've been in equity markets, all it takes is our president to change course in China to get more belligerent to cause, a mini correction. And let's be clear, this is certainly a mini correction. I think, when you're solving for growth at a reasonable price to complement either U.S. small cap or large and mega cap, and you're focused on middle market private equity like so many of our strategies are, the bigger concern is if we ever spill over into a full-blown recession. And fortunately, the probability of that looks very low right now.
And as you said, you guys are focusing on these middle market private companies. I am curious from a fundamental perspective how they are dealing with the sort of tariff back and forth, right? Because I would think the larger a company is, the better it has leverage and flexibility to deal with some of this uncertainty and volatility and all of the tariff headlines. And then when you kind of go down in size, it gets a little more challenging. So how are those sort of mid-sized companies dealing with it?
Yeah, no, great point, Julie. And when you think about the whole concept of growth at a reasonable price, whenever you own assets, that are growing revenue as an asset class in the, let's call it low end 8, high end 12% range, and then you have valuations that are basically at 10-year lows, and you have balance sheet leverage that's materially lower than large and mega cap PE, and lastly, your entry point valuation is materially lower. When you put that all together, you can withstand pretty doozies of a correction in the economy or a downturn, and you won't hit the revenue growth that you were hoping for, but you'll still have reasonably positive revenue growth. When you look at some of these big picture trends, whether it's tied to data center construction or infusion care or robotic surgery, or even boring businesses like paving or lawn care, if you're growing EBITDA north of 20, you could withstand some of the friction in the event that the tariff situation spills over without having material downside and still having, very attractive upside. So, a lot of this all starts with growth at a reasonable price. When you're in assets that have growth at a reasonable price, you can withstand more downside and still have a good outcome. And obviously, if things continue to be relatively benign, it's just a question of how much upside you have.
Troy, I'm also intrigued by the valuation question because, as you know, of course, the discussion in public markets is all about valuations getting stretched. Maybe that's one of the reasons why we fell so much Friday, right, is that discussion. And you're talking about these reasonable valuations on the private side, especially at a time when deal activity is really picking up. How are valuations sort of still remaining reasonable on the private side?
Yeah, so it's a really good point. So there's a couple things to unpack there. One is if you think of transaction volume, to your point, it is coming back. And from our perspective, that is the ultimate hammer that is going to drive valuations tighter relative to public markets. Private markets always lag. And what surprised us so far is that we haven't had any material systematic upside. We've had idiosyncratic upside in certain individual cases. But as deal activity continues to increase, and in the mid-market, we're expecting 10 to 20% more volume than last year, that should cause systematic multiple expansion, hopefully not to the point of 20 and 21. We're not rooting for that because when you're putting capital to work, you want to be able to enter at reasonable prices. Our point is over time, as long as public markets stay at elevated valuations, there should be some convergence, which means upside to evergreen NAV-based funds.
Troy, something else I wanted to ask you about on the private side is this whole first brands blow up, right? Which has sort of been sending ripple effects, particularly through private credit, but I think through private markets overall. For people who aren't familiar, this was an auto parts company that basically seems to be blowing up in spectacular fashion, and a lot of different entities had lent it money. This morning, there's the news that the CEO has resigned. How much, how concerned should we be about a situation like that, and maybe what it signals for the future?
Well, I think big picture, unfortunately, it feeds into this narrative, this false narrative that private credit is in a bubble. That being said, I think credit 101, you want to make sure that you have a diversified portfolio, because in the event, and you think over time, over our long careers, periodically you do get frauds that are straight up bad actors that engage in things like cross-pledging assets or pulling forward receivables. And so diversification, very, very important. Having a portfolio that's primarily senior or asset-based finance also helps mitigate that risk. One of the things that's interesting to me is that in public markets, you tend to have 2 to 3% defaults in high yield bonds and 3 to 4% defaults per annum in syndicated bank debt. And that's just the way it is, right? Because you're extracting income, and some companies fail, whether it's idiosyncratic or industry driven. For some reason in private credit, and I don't know who articulated that, there's this misperception that you're never going to have defaults. That's not true. You will. The key is to mitigate those, minimize the loss, and make sure your income is substantially higher, barring an apocalyptic recession, to provide a positive return, even if defaults do build over time.
Troy, good to see you. Thank you so much.
Great to see you, Julie.
That does it for Morning Brief. Much more ahead on Yahoo Finance, including opening bid. That's next.